Welcome to Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here is your host, Anette, Talie.
Welcome to another episode of Deal Closers. I am your host, Anette, Talie, and my guest today is Lennon Lee, the multifamily investor. Welcome, Lennon.
Hey, Anette. Thank you for having me.
I'm so excited to have you today. So let me tell you a little bit about Lennon. He is the founder and principal of BLD Capital Group, a boutique investment firm focused exclusively in multifamily real estate. Alongside his investment partners and investors, he has been involved in acquisition of over 1,500 units of multifamily real estate with an approximate market value of 150 million. Wow,
right.
That's impressive. He is a full-time investor based in Miami, Florida. Lennon is also the founder of the Multifamily Investing Club, a knowledge-based community and networking community, providing an educational and relationship-building platform for local multifamily real estate investors. He is the host of Se Habla Real Estate, the first ever real estate investing podcast in Spanish. He is the author of Passive Multifamily Real Estate Investing ebook. Lennon was born and raised in Venezuela and moved to the US in 2010. Wow, Lennon, that is awesome.
Yeah, that's me.
So tell me a little bit of how did you get involved in real estate? What's your story?
So 2010, we moved, I'm going to say we, that's my family and I. We moved to the United States from Venezuela. And in 2009, we had come to the United States and we bought a few condos here. At that point, we made a little bit of 23 at the time. Yep, 22, 23. I was just graduating from the university in Venezuela, and then after graduation, I moved here. So we already had those condos here, and then when we moved, we started buying a couple of other properties. So we had a pretty small portfolio of properties, condos and single family. We even had a piece of land that I basically was managing all of that, handling the tenants and the releasing the units and taking care of maintenance calls and stuff. Well, I wasn't actually taking care of the maintenance myself, but just doing the high level management of the small portfolio that we had. So that's how I got started in real estate in the US. And then fast forward to 2015, 2016, we started seeing that the portfolio was not performing as it should. I mean, it was good because we had paid cash for those properties at very low basis in 2009. But at that point, the rents were not really going up anymore. Actually, they were going down a little bit. So the return on equity that we had sitting there was not very attractive anymore. So we started looking at other opportunities, and we found out about multifamily real estate and how you could be a passive investor in this institutional type opportunities and all the benefits that come along with it. And that true passive nature of it was something that was very aligned with what we were looking for. And that's how we ended up, building then a company around that whole concept and bringing investors. And, here we are right now.
That's where it all started.
Yep. We're pretty much involved. This is what I do full time. And, we've been investing for the past 3-4 years in multifamily and bringing opportunities to our friends, families, investors, and it's been a good ride so far.
So when you started, did you start with your family or did you start by yourself?
Well, on the multifamily space, a little bit of both. So, like I like to tell people, I'm a passive, and not only myself, but my family as well, mom, dad, sister, and they don't live here; they live in Panama. So, even more so, we were looking for them to have some passive income and passive investments here in the U.S. And me being here, same thing. We are passive investors first. We love everything about the the benefits, of course, but the passive nature of it and how we can, build relationships with people that can take care of our investments. So that's what we started doing first, all of us, me, my family, and everyone. But I personally, at the time when we started looking at these investments, I didn't really have a job at that point. I was doing some real sales, residential sales and rentals, which wasn't much fun for me. But so I figured, well, you know what, I can definitely build a company around this and bring value to families and investors like mine. So I started becoming definitely active on this on the investment side and raising equity and learning about the whole model until eventually last year we went from fully passive investors to fully active investors, and everything in the middle we've done, meaning we've been partnering up as co-sponsors, as co-GPs with other operators in other states, and then we've done our own deal at this point. So it's I guess it's gone full circle at this point. Yeah.
Oh, excellent.
The Deal.
So let's talk now about the deal. So what type of deal are you gonna tell us about today?
Okay, so just like I mentioned, just I guess for people to understand our model, again, like we're passive investors first. We're trying to build a structure and an infrastructure for the company that have us be, and our investors, of course, very passive, meaning we trust a lot on the relationships that we build with other operators with whom we deploy our capital. So that being said, all this 50 at this point, it's more like 2,000 units, maybe a little bit more, that we've been involved in, that we've invested in, and the majority of those have been through partnerships with other operators. Okay, so they lead the charge, they find the deal, they secure the financing and everything, and then we jump on board by bringing value depending on the deal from different angles. We could bring the risk money sometimes. We can do help with the marketing side of things, maybe help drive traffic to the property. So that's more like the after closing asset management type thing. Of course, we do investor relations for all of the investors that we bring to the table. We obviously raise equity. We do help with the due diligence. It depends, right? So that's the typical deal that we do. It's more like partnerships with these other operators. That being said, we did our first deal from top to bottom last year. So yeah, that early 2019 or so. That's almost a year ago at this point. And then also last year we did another deal, 278 units in Orlando. The first one that I mentioned was in Jacksonville. So I don't know. I mean, I think maybe we could talk about the Jacksonville deal. I've talked about it a lot at this point, but I think it's the best one where we can maybe go a little bit deeper, where I have definitely been more involved in all aspects of the deal. So I think that's a good one to talk about.
Okay, perfect. So it's a multifamily. How many units?
Yes, Class C plus multifamily. We acquired 138 units. That's in Jacksonville, Florida, in the sub-market called San Jose. It's also on the south side sub-market of Jacksonville, and it's a 1974 construction.
And how did you find this deal?
This was straight up on the market deal through, I believe it's Knight Frank that had the listing. Yeah. And we had at that point, we had been involved with, well, in the market actually. So we had been going to Jacksonville several times to get immersed in it and understand the markets, and obviously start building the local team, meaning starting interviewing property management companies, and of course building relationship with the local brokers. So by that time, we already had a good relationship with the listing broker who actually got the listing of the property. And yeah, I mean, he brought it to us. We had, again, a good relationship. So that good relationship was fundamental for us actually acquiring the deal, or not acquiring, but getting awarded the deal.
Right,
at the end
because
of the day.
you went over something very important. You were already researching the market, so when you saw the deal, you knew it was already probably a good deal,
Yeah.
or it was close to what you
Yeah.
were looking. And then the relationships that you created with this broker, he brought you the deal, so then that helped the whole transaction.
Yes, yes,
And these are
100%.
these are all things that you do before you even find the deal, right?
100%. That's it took us probably, I don't know, 4 or 5 months of us getting, traveling to Jacksonville, looking at the market, driving around again, and building the team. At the point that the deal came to market, we had that a good relationship with the guy. He he trusted us at that point. He knew that we were that we were very interested. We knew that we had a good team. Basically, we have our at that point we had all of our ducks in a row, and he communicated that confidence that he had in us to the seller, to his client, and we were able to jump on a call with the seller and explain our plan and everything. We were very creative on the business plan, a little bit different from from other groups, and that's probably what got us the deal. And we paid what they were looking for, so we didn't get it at a discount or anything. We pay market value, which at the end of the day, market value, that's what we thought we had paid, but ultimately the appraisal came back when we acquired the property for almost $500,000 more in value. So we had like 450, I think it was, equity built in from day one. So that was great to have.
That's amazing. So
Yeah.
that's kind of like what I was saying, that you already knew the market and you knew that it was a good deal, when it was presented to you, because you were already in the market and studying this market. So I guess that covers how did you negotiate this. You talked you were able to talk directly to the seller, and you ended up paying the value that he wanted, but it was still undervalued, even though it was what it was listed for, I guess.
Yes, it was a simple, I guess from the legal aspect of it, it was a very simple, very straightforward negotiation. There was one thing that we were able, because we paid 12.1, that was the 12,100,000, that was our offer, but we actually ended up paying $30,000 less. Basically, that was kind of wasn't a credit per se, it was just a discount on the price, but because the seller had agreed initially to take care of the parking lot, reseal and repaint it, and they never did it. By the time we actually closed on the property, that had not been done. So we got a little bit of discount. So that's that type of things you negotiate along the way. During the due diligence, you find out things here and there, so you can renegotiate when it makes sense, when it's something that that's fair. But other than that, even if it's not fair, sometimes you want to not negotiate too hard in terms of like you don't want to appear like the guy that it's putting in an offer very high, but then when you go into the deal and you do the due diligence, you start coming up with things to bring the price down. That's called retrading in what we do, and it's not very well seen. But sometimes if it needs to be done, then you can do it.
Yeah. So how did you found? No, I asked you already how you found. How did you fund this deal? How did you buy it? Did you use a loan? Did you have investors? Tell me about that.
Yes, we have a 80% loan to cost bridge loan that we got through our mortgage broker from Walker and Dunlop, and he found a good product for us from a national bank that I don't know if they're actually national, maybe regional, but anyway, it's a pretty well-known bank, and they provided us a good product. It's a 3+1+1, meaning it's a 3-year loan, it's a 3-year term, plus two extensions, 2 1-year extensions that we have availability to use if we want to. that we yeah. So then the rest. So that's for the debt, and then on the equity side, we ended up raising 4.15 million, and that's that's all the equity for the deal, and yeah.
Excellent. So why did you choose to go with a bridge loan, and for who? Can you explain what a bridge loan is?
Yes. So basically, a bridge loan is what you use when you're trying when a property. This is in this case, it wasn't exactly that because this property would have qualified for a permanent agency loan with Fannie or Freddie, but we decided to go with the bridge loan. And again, the bridge loan typically it's a loan that you use to bring a property from some sort of a distressed or not stabilized, actually not stabilized status to a stabilized status. So maybe you get a distressed property that you're not able to fund or get a loan with the agencies because of the risk profile. The occupancy is not there. It needs a lot of deferred maintenance taken care of and all that. So the agencies are not going to finance it. So you use a bridge loan. There are lenders out there that obviously you're going to get the terms are a little bit more aggressive and shorter term because it allows you to go from point A to point B and have the flexibility to refi, go through a refinance event to actually go into the longer term debt. For us, and specifically for this deal, it made a lot of sense because the property has had such potential for us to go in, and it still has. Of course, we're still working on it, and we had the opportunity to, or we actually wanted to have the opportunity to either, when we finished our business plan, to refinance into a longer term agency debt, or have the flexibility to say, hey, you know what, we've added enough value that we think we can sell the property and actually exit the deal at year 3 versus having a long-term debt from the get-go with high prepayment penalties. That it didn't make sense for us to then get out of the deal in 3 years. So we would have to hold the deal again, making sense of it financially. It wouldn't have made sense to if we had a long-term debt for this particular one. So yeah, that's the whole thought process around it.
Oh, excellent. Yeah. So it definitely makes sense. And then at year 3, your investors, for example, they would, if you decide to sell them, they would get all their investment back quickly instead of doing a 5 or 7 year, depending on what you picked.
Yes, we still have a 5-year plan. That's our pro forma. That's what we're planning for, and everything. But again, we want to have that flexibility. There's some deals that you already know going in that you don't really that you want to hold for the longer term. So then you want to ultimately what you want to have, it's a loan with terms that are longer than what you have for your business plan, right? So, and then in our case, we have exactly what we want, with the ability to, with that flexibility that the deal and the business plan calls for.
Okay, so your 5-year plan, it's the exit strategy is to sell it, or are you planning to pay off and then keep it?
No, we plan to sell in 5 years. That's the plan. But again, we could, if we could do it in 3 and it makes sense, we have the structure, the capital structure to actually do it and not be penalized as much. Yeah.
Excellent.
Or at all, actually. Yeah.
So what was your biggest takeaway from this experience? And this was your first syndication, right?
The first one from top to bottom, that we are the lead sponsors and that we secured everything. Yeah.
Yeah. So what was your big takeaway that you kind of learned on this transaction?
Well, there's quite a few, but honestly, it's been understanding what you like to do and what you don't like to do. So, playing to that self-awareness of where your skills are and what you're good at and what you actually love doing. The experience has been amazing. Again, I'm a passive investor first, and I'm building this network of partners with whom I'm going to deploy my capital with. So that's the big picture model for what I do. So doing the deals myself, and it's not only me. It's there's a team, there's a couple partners there, but doing the deal from top to bottom myself has shown me that, first of all, that's not what I want to do. I mean, I'm enjoying the learning part of it. It's amazing because at the end of the day, I'm actually becoming better at vetting operators and asking questions to this new partners or partnership that I'll be building. I know what questions to ask. I know how hard they need to work. I know what it takes at this point. So I've been on both sides of so that's been the major takeaway so far, that understanding how everything works on the nitty gritty part of it, on the asset management, on all the challenges that you come up against and during this process. It's obviously it's a great learning experience that's gonna help me become a better passive investor at the end of the day.
Absolutely. Yeah. It's like when people ask you how to learn to manage a property, the best way is to do it yourself. And then you hire somebody else, because then you know what it takes. You know if they are spending too much money, you know if they are, taking too long. So it's kind of the same idea. You did one yourself, and now you can, delegate it, or you can partner with other people, and you know exactly how it works.
Yes, definitely. And, that's what it is. If another opportunity comes by where we need to tackle a deal, at this point, we're not actively sourcing deals ourselves. We're more, at least we're recording this on the beginning of 2020. So yeah, for this year, the goal for us, it's more to jump on and increase our equity raising capabilities and our educational platform and all that. So, but that being said, if another deal comes through that, that we can tackle and it makes sense, even though, again, I'm not, and I can tell that with all honesty, I don't love the asset management part of it. I'm more than happy to do it. Now I know how to do it. And if it makes sense, it makes sense. You don't want to let a good deal pass, but
and you can always also bring a partner that likes to do the asset management into your team.
Yeah, for sure. Well, actually, which is what we do, right? We partner up with other multifamily operators, sponsors, syndicators, however you want to call them, that are doing it full time and have a team and everything. So we bring the value, again, of obviously our investors and our knowledge on and our experience on the asset management and investor relations side. And then on the asset management, it's very specific things here and there that we can help with, but ultimately we tell them, hey, this is your show, you're running the show, we're trusting you, we have a relationship, and it's your thing. We're not involved in the day-to-day. We're not having the pressure that they have, and that's the way we like to do it. That's why for us it's a very organic process of the relationship building with these operators and with these companies that we end up partnering up with, because we do want to be passive investors, obviously with some sort of control to protect our investors' interests, but we're trusting these guys very much. We let them do their thing, and it takes a lot of trust, so it takes time to build that trust. So that's, we're going little by little on that side, but that's the way we like it.
Absolutely.
Expert tips.
All right, so now we are in the part of the show where you're going to give me 3 tips, and you are going to give me the tips on passive investing.
Yes, we discussed this a little bit, and I think I wanted to talk about the passive investing side. And as a passive investor first, probably the 4th time I mentioned that today, I think it's where I can bring the most value. And it's nothing, it's nothing that people probably don't know, but if anything, I would like to reinforce some of the things that I think are very, very important. So the first one would be, a lot of people ask me and are, I guess, wondering, how do you vet a new syndicator? Like, if you want to be a passive investor, how do you go about it, right? Like, what? And my approach is, again, like I mentioned before, it's very organic. It's very down to the personal trust that you have, more so than the actual credentials and stuff, right? Because the way I see it is, there's a lot of companies and teams or individuals out there that have the credibility, that have the track record, that are, they have a lot of integrity. They're not bad guys or anything at all. The clean background check when you do it, and everything. You're probably going to find a lot of them actually out there that are very well capable of executing a value add plan, or whatever the plan is, right? So what it boils down to really, it's how well do you get along with that person, and do you like them? As simple as that. So I guess the actual advice is, make sure to do business with people you like. It's not enough for them to have the credentials. Again, that's my take. That's the way I go about it, because this is a relationship that you're building, and it's a marriage that you're getting into, basically. And you are depending on these guys, and you are going to get information from them. You're going to get reports from them, the communication, etc. And I wouldn't like to have that sort of relationship, especially when there's money and harder money in the middle, with someone I just don't like. I don't like the guy. I don't want to be talking to the guy or the guys. Why would I get into that? So yes, I'm not saying that don't pay attention to all the other important things, references, background, track record, all of that. We all know that. But make sure to do business with people you like.
Excellent.
So,
Tip number two.
Number two would be, just play the long game. Very simple, very straightforward. But as a passive investor, you need to understand that it's not a get rich quick game at all. And especially as a passive investor, from all angles, it's the same. But again, especially as a passive investor, you want to play the long game. A lot of people ask me, especially at this point in time, they're not sure if they want to get in the multifamily space or not, because everyone says a recession is coming, or we're at the top of the market, and it might not make the returns that we were seeing at the beginning of the cycle, or at the middle of the cycle, are no longer there. And yes, that's true. So if you want to make a quick buck in multifamily, meaning going to one project and 3-4x your money in 3-4 years, that's not going to happen. Under certain risk profile, I'm talking generally speaking. And so I guess the actual advice is just that: play the long game. Make sure that you build a strategy that when you look back in 20-30 years, you look back and you look at your returns and you're happy with them, then that's a good game. Sometimes you're going to see high returns, sometimes you're going to see lower returns. So if you play the long game, you can definitely adjust your expectations, and if you want to keep the same risk profile with capital preservation in your mind, then you're going to understand that sometimes the returns are not there. They are there and the benefits are there. Everything's good, but maybe not as good as some other times. So just look at the long term and play it that way. That's the second one for sure.
All right. Let's go to the third one.
And then the third one, it's definitely get educated. I think maybe along the same lines, like people hesitating whether they should get into the game or not. It's a matter of the way I see it. Knowledge translates into confidence, and it translates into action. And that's what you want to have, right? So knowledge, then confidence, then action. It's hard to act when you're not confident in yourself, when you don't have the knowledge. So get educated. Listening to podcasts like this one, Bigger Pockets. There's a ton of podcasts out there, a ton of books at this point. Google is just, it's just the biggest encyclopedia, if you will, in the history of mankind. So there's a lot of resources.
And if you speak Spanish, they can listen to your podcast.
If you speak Spanish, you can listen to Se Habla Real Estate. That's what we talk about. We talk a lot about multifamily investing and just real estate in general. So yes, for sure.
And I totally agree with you.
And then
there is so many free resources. I mean, you can start and you can get a lot of knowledge with free resources. And then if you want, then you can start paying for some courses here and there, but you don't have to spend $20,000-$30,000 on, on the first course that you take.
No, not at all.
So much for free.
Yeah, not necessary. I mean, and I guess ultimately, if we're just talking about real estate in general, the idea is for you to get educated, understand, okay, how is it that I want to invest in real estate? Do I want to do private lending? Do I want to do passive investing in syndications in multifamily or in self-storage? Like, there's a ton of options. Or do I want to house flip for a little bit and then start going to it wouldn't make sense for you to start paying anyone or anything if you don't have the clarity of what you want to do. And that brings me, I guess, to an extra tip, which is
bonus tip.
The bonus tip or the bonus advice is, sit down and make sure to understand why are you doing why are you doing this? Like, is it that you don't have a job and you want to become a real estate investor and now you want to be super active? Because the strategies that you can pursue with that mindset are going to be different than the strategies that you can and should pursue. If you are, let's say, a high earner physician that just wants to, get involved in real estate because you understand the benefits of investing in real estate, but you want to be totally passive. So that understanding of why you're doing what are you chasing? Is it aggressive growth of your capital, or is it cash flow anchored to a capital preservation strategy or investment? I think what that ultimately comes down to, once you start looking at it that way, it's you have a clear criteria of the product or the strategy or even the markets and everything that you want to invest in and who you want to invest with, which at the end of the day is what you want to have. You want to have that confidence. Okay, this is what I do. This is my criteria, and you want to be disciplined with it and stick to it. And that's that's a good ingredient for a successful real estate investing, I guess, career or path.
Yeah, that's awesome advice. And also, that doesn't say that in the future that could change as you get involved. But I think you totally pointed something out that is very important, that you need to know where you're going before you start, because otherwise you're going to get distracted with a lot of things and then you're not going to do anything. So you have to kind of decide which way you're going. And then in the future, if you realize that maybe that's not what you wanted, then you can change. When I started, I just wanted to buy a property for my kids to have in the future, and so they could have college education if something happened to me or if we couldn't pay it at the time. And once I bought the second one and then the third one, that changed into I want to be a full-time investor and actively. So it can totally change. And with you, it was kind of the same. You wanted to be passive, and then you started doing your own syndication, which is a lot active. So it can change over time for sure.
Yes.
All right, Lennon, it has been such a pleasure to have you on my show. I'm so excited that you are here and sharing all that knowledge with my listeners. And how can people find you if they want to get in touch with you?
Yes, for sure. So I guess the best way, it's through the website, the company's website, which is BLD Capital Group.com. You can put it on the show notes if you can. That'll be there. And there's a form there you can fill out, and it comes directly to my email, where we can set up an appointment if you want to talk, or we can exchange emails. I'm active on Instagram as well, the Multifamily Investor, and I know I'm on all the social media platforms, Bigger Pockets, Facebook, LinkedIn. So you can just find me around there, get in touch with me. I guess, yeah, that's.
And your podcast is on iTunes?
The podcast, Se Habla Real Estate Show. Yes, it's on iTunes, on all the platforms as well. iTunes, Anchor, Spotify, and all of those. So yeah, we do Spanish.
But you do English too,
episodes,
correct?
Episodes Spanish, as I said. We've done a few, and we're probably gonna include a few English episodes. Maybe I'll throw this one and put it on my podcast as well. Why not? But yeah, mostly in Spanish. Yeah.
Excellent, Lennon. Thank you so much. Bye.
Bye.
This was Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.